Thank you everyone for joining us this morning, and welcome to the Why Stakeholder Capitalism is a Good Bet in Times of Crisis event. This event is a part of our social impact webinar series, which was designed to engage our social enterprise community during New York's shelter-in-place recommendation. And our intention is to continue to disseminate best practices in the social enterprise sector, as well as discuss the pressing social and environmental challenges resulting from the current pandemic to ensure vulnerable and marginalized community needs are still being addressed. I'd like to turn it over to Georgia Levenson Keohane, who will be moderating this discussion today. Georgia, let me pass it on to you.
Terrific, thank you. Thank you, Diana, and thank you. Let's see, will we keep the slide up, or are we?
Yes, let me turn it on.
Okay. Terrific.
I think your camera might be covered.
My camera's covered? Oh, that's weird. Ah! How did that happen? We just did this. Oh no. All right, well, I may have to, that's so cuckoo. All right, well, I don't want to hold everybody up. We'll continue. I can figure it out in a minute when we switch speakers. Can everyone hear me? Okay, sorry about that. That was so much for all the testing. So thank you, everyone. Thank you, Diana, Hannah, Sandra, Bruce, Damon Phillips, all my colleagues at the Teamer Center for this work this morning. Thank you for all your hard work. And really for just your incredible pivot. The business school in Columbia more broadly has done an incredible job moving content like this online, and helping us all continue to think about business as a force for good, really now more than ever in incredibly challenging times. I also just want to thank my fellow speakers and today, Liz Luckett, Nick Maynard, and Martin Whittaker especially. Once I get my camera fixed, it's a little weird, but anyway, we're in for a breakfast of champions. I think that these three, as you all have seen in their bios and will hear, have really been at the forefront, certainly pre-COVID, during this crisis, at the front of sort of understanding and working on business as a force for good. And of course, thank you to everyone who's joined this morning. Again, my name is Georgia Keohane. I teach in the Themer Center. I teach on social entrepreneurship, and really have spent most of the last 20, 25 years at kind of the intersection of the capital markets and social impact. Most recently was head of ESG and philanthropy at a private equity firm. Before that, executive director of Pershing Square Foundation, and have really actually spent the last couple of months setting up and running a COVID response and relief fund. But I think what we're here today, this morning, to talk about is a piece my book publisher asked me to write a few months ago on stakeholder capitalism. And I dragged my feet for a few months and then found myself in the midst of COVID, and never let a good crisis go to waste. As Churchill said, but I think he was not thinking of Zoom so much as frontline workers. But anyway, sat back a little bit and looked around and said, hey, we've gone from a period in December, January, where ESG, responsible investing, impact investing were really all the rage in some ways, and wondering whether whether the articulations at Davos and whether the Business Roundtable commitments to stakeholder capitalism and BlackRock, Larry Fink, et cetera, whether that was really the apex, or whether now that all of those issues, trillions of dollars in assets, ESG assets, 500 billion or so in impact assets, whether that can actually be sustained. And looked around and saw that we, whether it's companies or investors in this crisis, I think particularly in an absence of federal leadership for sure, but challenges for the public sector. We have been seeing instances of the private sector, companies large and small, really stepping into the breach. And I guess the question, I posed in my blog post, but I really wanted to pose to this group, is whether we really think that this is sort of an avenue for real structural change. As we all know, and it's a little bit trite to say, but this crisis has certainly laid bare and exposed and exacerbated, obviously, some very gaping and, frankly, obscene and certainly unsustainable inequalities. And I think the question is, is the private sector or public-private partnerships more broadly in for the long haul to start to address some of those, or will we kind of return to business as usual? So with that frame, I guess just briefly some housekeeping. What I'm going to do is turn over, I think I'm going to do this alphabetically, ask Liz Luckett to speak for a bit, then Nick, I'm going in alphabetical order, so Nick Maynard from Commonwealth, and then Martin Whittaker, who runs Just Capital. And then I think Diana, I will also try to fix some tech issues on my end, but Diana's going to help me track some questions, and then sort of after those three speakers, I think we'll open it up to a broader discussion if that works. So Liz, everyone has everyone's bios. I'm not going to spend too long on intros, but Liz, I'd love to start with you. Liz Luckett, as all of you know, is the managing partner, founder of the Social Entrepreneurs Fund, leading early stage VC firm and set of funds focused on technology, software companies that really are focused on poverty and inequality, built around a very interesting small data thesis. Liz, I'd love for you to just give a little bit of context, talk a little bit about the genesis of TCEF, why your fund exists and how you think about it vis-a-vis, sort of the explosion in the impact investing industry since you've been at it, and then really what you're seeing now in the pandemic, companies within your portfolio, like companies in any portfolio, struggling a little bit, some doing really extraordinary things, and where you think this is all going. Thank you.
For having me. Oh, am I mute? Can you hear me?
Yeah.
Okay, sorry. Thank you for having me. It's a pleasure to be here. Yeah, the genesis of the Social Entrepreneurs Fund was, we got started in 2012 as a group of high net worth individuals who were interested in the intersection between philanthropy and venture, and wondering if this concept of impact investing was really something that looked more like philanthropy or looked more like venture. And so the first fund was really an experiment thinking about that, and we then moved on to two more funds. We're on our third fund now. And my own background is really focused on tech and data. I ran a company for a while as a startup, which did data analytics and outbound campaign management, focused on targeting consumers around pharmaceutical and financial services. I worked at Citi with similar work in credit cards. And so I think that concept of finding consumers and aggregating them was evolved into thinking about how to do that for better purposes. And so at TCEF, we invest in tech and data-oriented companies that offer non-predatory services to low-income communities. We focus on financial services, health and social services, and access to government services and job training. So we think that, from my experience and others, that aggregating low-income communities has been expensive and it's difficult, and therefore the cost of doing that is transferred to the low-income community. And as a result, large corporations try to reach them, and they do it in either a predatory or a concessionary manner. And we think this thesis is more relevant now than ever in the current crisis. The community we focus on for the last 8 or 9 years is just steadily expanding. And some examples of what we think egregiously happens in reaching this community is that there are fines and fees on low-income communities that make it really expensive to be poor. The bank overdraft fee market in 2018 was $34 billion. That's just fines and fees for people who cannot afford that. Remittance businesses, which is about $56 billion annually, charges an average of 7% per transaction, which means intermediaries made $4 billion off of immigrants sending money home. Calls from prisons are about $1. They average $1 a minute. Average night in the emergency room is $1,400. So we're looking at investing in companies and technology that are data-oriented and address these costs. For example, access to credit and alternative credit scores, or finding new ways to determine who's creditworthy, paying for insurance while you use it, such as car insurance while you're driving your car, affordable remittances, potentially using things like bill payment in other countries instead of cash transfers, and algorithms that automate the reimbursement of fines and fees. In healthcare, we focus on affordable access to care, largely around chronic diseases that disproportionately affect low-income communities, such as diabetes, obesity, and hypertension. We focus on solutions to addiction and mental health. And then in government services, we think about making sure low-income communities can access the services available to them, like modernizing enrollment in Medicaid, food stamps, retraining people also to earn higher wages. We invest in these companies with an exit strategy of an acquisition by a corporation who are basically reluctant to give up or cannibalize existing revenue streams. But we know, they're not keen to keep treating people poorly. And so purchasing that innovation, we think, is necessary for them to responsibly serve these communities. So you had asked what's changed during the crisis. And what we're seeing is that in venture specifically, we think there's an acceleration of certain trends. So things that have been going on a long time this is their day. So remote learning and training clearly is something that is no longer a slow adoption. Telemedicine is prime time now. Better transparency into supply chains, we're seeing, something we've been focusing on for years, is now matters more than ever. Access to credit that helps people get back on their feet. So in general, we're just seeing these are the things that people are, this is our pipeline, and it always has been, and it's particularly relevant today. In terms of venture and investments, there was a bit of a pause as this got started, but we're seeing strong companies still raising money at the same prices. There's been some discounts, but in general, mostly the best companies are raising money at the same prices as pre-COVID. We're also seeing, as everyone knows, this was a tremendous boom period for venture. Lots of people had raised lots of money. So you're still seeing the effects of people needing to deploy that capital. I think what might be interesting, as you had asked, Georgia, is to go through a few specifics, some companies in our portfolio and how they're handling COVID. One we spoke with yesterday, which is Clínicas del Azúcar. It's they do low-cost diabetes service for people in Mexico. It's a type 2 diabetes for subscription of about $250 a year. They now have 16 clinics. They've treated over 120,000 patients in the last 10 years. Statistically, because diabetes is the #1 killer in Mexico, it's also the #1 cause of suicide. There'd be 18,000 of their patients would probably not be here if they weren't in existence. And during COVID, the Mexican government stopped offering diabetes care. They have clinics that they offer care through. They're not very good quality, and there's about a 3 to 4 month wait to get in anyway, but they've stopped offering that service. But they did deem Clínicas del Azúcar as an essential business, and it allowed them to stay open. Just before COVID, they opened a new clinic in Juarez, which is just a few minutes from El Paso, and they're seeing a ton of people pour over the border from the US to use these services. So this is a company that has always been critical, and we're just seeing that their revenue is growing despite their inability to allow everyone into the clinic at once. They've clearly had to pace patients, and they're seeing revenue growth anyway. So that's a critical service. Another company is Bertha, a company we've been invested in for many years, which offers a comprehensive online directory of 350,000 social services across 50 states. It is the largest, probably, directory of social services in the United States. like in New York, those silver kiosks on the sidewalks, the homepage is Bertha. So if you need help, you go to their site. And during this crisis, as you can imagine, they've become very important. They launched something called findhelp.org, which has allowed people just to log on for help. They repurposed some of their analysts to find and comb through the US for COVID-related help, and are posting that. And then they've built a management tool to search the data through Tableau, so that foundations and clients, foundations, cities and counties across the country who are interested in helping people for what they need right now. This is a real-time tool for what people are searching for help from. So they can find in one county that everyone's looking for free diapers, or somebody's looking for food pantries, etc. And then aid money can actually be very targeted by zip code. I think one of the last questions you had asked was just what's going to happen, and I think that's a tricky question for everyone. But I think what needs to happen, and what we've always hoped would happen, is the concept of impact investing simply goes away. That they're just companies that start to take into consideration how to treat people fairly, stop being punitive, and look at what is growing to be probably half of our population who is in desperate need of help, to treat them with more consideration. I think that might be my 10 minutes.
No, Liz, that's great. Thank you. And I know that there are going to be a lot of questions, and I guess I'll ask folks to try to hold them, and then we'll get back to it, because thank you. Those were terrific examples and raised a lot of pretty tough and challenging questions, although a lot of bright points too. So let me turn to, I guess, to Nick. Next, Nick Maynard is the SVP at Commonwealth, and just a career expert on financial health, security, inclusion. Again, a lot of this pre-crisis, particularly when it comes to savings, emergency savings. I haven't seen the jobs report this morning, but I think there could be 40 million new unemployment insurance claims, and so thinking about clearly what that means for people's income or lack thereof, financial health insecurity, savings. Nick, this is something you've been working on for a long time, and I think have thought about it, broadly, also clearly in the context of the workforce and employers, and what makes for a good employer, and what makes for a robust employee. And as we talk about things like ESG, we often talk about the E, because we can sort of measure things like carbon or emissions, but thinking about worker well-being, whether it's paid sick leave or other, is something you know a lot about. So we'd just love for you to talk about your work at Commonwealth generally, how you've started to think about some of these really pronounced issues in the crisis, where you think this is headed.
Great, thanks, Georgia, and really appreciate the opportunity to join everyone on today's panel. Meeting Liz for the first time, it sounds like amazing work, and have been collaborating with Just Capital and Martin's team and Alison Almond's for a while now on some of these issues. As Georgia said, Commonwealth organization. We are focused on building and enhancing financial securities for low to moderate income Americans, so that they can then unlock the opportunity to build wealth. In the stakeholder capitalism frame, I guess you could sort of say we're boots on the ground. We are working to facilitate within the corporate structures the opportunities for companies to really tackle, in the case of worker financial security, making that happen at scale. We do our work through research, designing, and testing innovative solutions, and then we scale those proven solutions with large corporations. This can be product solutions, these can be process improvements. You can think about employee onboarding, you can think about setting up your payroll and being able to split payroll into different buckets. These could be marketing and messaging innovations. You could think in terms of outreach and engagement with employees around benefits and opportunities to build security. You could also think about channel innovations, which I'll get a little bit into, which sets the opportunity and the plumbing, if you will, within structures so that corporations can make an easy yes, as opposed to putting up roadblocks. One of the innovations that we're most renowned for is in working with Walmart and Green Dot Bank on the Walmart Money Card. We were engaged by them to help build a liquid savings account on the Walmart Money Card. Walmart Money Card is a GPR reloadable card, which works very well for many financially vulnerable Americans. And we took a proven innovation, PrizeLink Savings, and put that on that card. And in 2 short years, it generated north of $2 billion in liquid emergency savings for Walmart customers. I will note this topic throughout my little conversation here, but what is liquid emergency savings? It's I grew up as a child of 2 accountants in Missouri, and I thought that this was a widely available tool. You go to the bank and you save, but it turns out that there's a lot of inhibiting factors to getting to a small balance account that you put small amounts in, you build it, you tap it when you need it for whatever you choose to need it for, then you rebuild it and tap it again and rebuild it and tap again. That is a scarce commodity in the US financial system. So we work a lot on that. Prior to COVID, as Georgia said, we spent a lot of time thinking about these issues that have come to the fore have really been prevalent for American workers. 78% of Americans lived paycheck to paycheck before COVID-19. We've been working for years on the liquid savings crisis, as I mentioned, and the common Fed data around 40% not having $400 in liquidity, and liquid savings being a pillar of financial insecurity, and a lot of data formulating now around how folks who have some of that savings are weathering the crisis a little bit better than others. So our work, as we think about the issue of financial security, when we think about what role corporations should play, we think about prioritizing workers and worker financial security, because the research shows that companies that put these practices into place see productivity gains, they see turnover reduction, they see absenteeism reduction, they have the ability to attract more talent, and there's greater brand trust as folks seek out brands for companies that are doing positive actions for workers and other attributes. I won't go into the details of the studies that support that, but one of the most interesting ones that I always like to talk about is researchers at University of Pittsburgh worked with a large trucking company, and they found that more financially stressed drivers were likely to have a preventable accident. And coming from, when I talk to folks that I went to business school with, this is a fascinating example because they were able to tie it to the P&L and to insurance costs and see that those workers were stressed and identify that emergency savings and the lack of a liquid cushion was causing that stress, and then able to structure an intervention to address that, reduce that stress, thus reduce accident rates, and then improve the P&L. That's a really strong connection of worker security to a financial tie that we would love to see more of in the space to think about these issues and how they become even more material than we think they are today. So what have we seen in the course of the crisis in terms of some shifts? At the individual consumer level, we've definitely seen a focus on workers in certain industries being exceptionally relevant, and I'll get to that in a minute, but I think there's an interesting thing that happens in these times of crisis, which we saw in 2008, which happened after the market crashes in the dot-com bubble in the 90s and so forth, is there's a keen interest in many quarters in emergency savings that actually arises in prominence as an issue, and many Americans engage on it. So the National Endowment for Financial Education has found in an April survey that one of the key financial stressors, even more than job security and income fluctuations, is not having enough money in emergency savings. And then we've seen actions reported by consumers in terms of FinTech apps like Capital in March reported that a 500% increase in the proportion of new users creating an emergency savings goal. So from an individual level, this issue of I don't have this liquid cushion starts to come to the fore. At the corporate level, we see a lot of different responses, and I'm sure that Martin and Just Capital do amazing work focusing here, have a lot to say. I would just say that we have talked a lot in our work about the broad array of tools that are being raised to the fore, like emergency cash assistance, paid sick leave, dependent care, temporary pay increases that we would hope would be permanent pay increases, because that extra income can be very important to families. And then I think from an investor standpoint, we're still seeing a growth, not a full-fledged jumping in, but a hope that there's an awakening to a positive role that they can play in focusing attention here. We think that the S might be gaining a little bit of momentum. It's an area where there's not a lot of great data linking worker financial security to investors, but there's data starting to be that we're starting to research around what ESG funds are doing, and ones that have a strong S and the S that's contributing to performance. We've always felt and seen that workers are financially material, and they do drive value for companies. It feels like there's a bit of an awakening or shift in the moment around that for investors. In terms of a few specifics, I'll take a little bit of a different tack probably in talking about some of the inner workings of the employer system, as opposed to talking about individual companies. I think one of the things that we are working hard to do is engage vendors and collaborators with those corporations to build the infrastructure tools so that it's much, much easier for companies to say yes, for example, to having an emergency savings benefit. So one of the areas that we focused on and spent a lot of time with in the last couple years is retirement record keepers. Retirement record keepers have grown their footprint from 401k to adding tools like financial wellness and student debt repayment. They have a lot of tools to help with financial wellness assessments. And across many of these firms, they're seeing that the #1 need appears to be, across many income levels, emergency savings, which isn't surprising given the data that we talked about at the beginning. Another interesting dynamic here is that the CARES Act legislation pointed to the retirement account as a place where Americans could go look for emergency cash if they needed it, by changing the structures of withdrawals on hardships and how that would be played out. And so there's a recognition that that system becomes a place that potentially the offering of a liquid cushion as the first point would make a little bit more sense than tapping the long-term retirement security of Americans in inefficient ways. We have collaborators in this space who've identified that employees are really looking to enroll in payroll deducted emergency savings programs. So we think that payroll firms have a part to play in helping corporations find ways to allow businesses to offer benefits that then build financial security. So easy splitting, easy onboarding processes, links to quality tools through the payroll process of setting up for each individual employee, or the payroll touch points. There's a lot of opportunity to build and reduce friction so that consumers have the opportunity to have the tools they need. We also are looking at and see the opportunity with FinTech, not to name any particular FinTechs, but FinTech is in a significant position with some of the new tools and designs and approaches and how they use technology to solve some of these issues for corporations. And we spend some time in the work that we do trying to think about the role that FinTech can play. I will say that a lot of this is built around work that we're doing as part of the BlackRock Emergency Savings Initiative. Georgia, you mentioned Larry Fink earlier. The BlackRock Foundation has put together a collaboration of Commonwealth, Common Sense Labs, and Financial Health Network to tackle some of these issues around emergency savings. And we're seeing that additional attention and focus and push across these areas to help raise the awareness in the stakeholder capitalism conversations that these financial security tools are very, very important. So as we think about the boots on the ground role that we play and what the lasting impacts would be that we would like to see, we would definitely, I would say, want to see that worker financial security is material. That a lasting part of this is that the grocery worker is not just essential now, but is it viewed essential at all times? That's been a key piece of our work prior to COVID and continues going forward. We would definitely like to see investors get more engaged and to help facilitate that with them and help them understand the role that worker financial security plays on value for companies and to see that continue to play out. So I think that's my 10 minutes and I'll hand it back to you, Georgia.
Awesome. Thank you, Nick. That was great. And again, lots to come back to. I think we could, be here all day or every morning, but let me shift gears a little bit. Martin, I'd love to hand over to you. As you all know, Martin is the founding CEO of Just Capital, where they measure and track and engage with companies on all sorts of corporate responsibility initiatives and measures, some along the lines that Nick described, related to sort of financial security and health of the workforce, but really along a much larger sort of stakeholder continuum, and that was pre-COVID. And for those of you who have not recently been on the Just Capital website or sort of on their mailers, I would say that Just is doing an extraordinary job, I think, tracking COVID response of a whole bunch of companies, who's doing right by their workers, their customers, who's having to make cuts, and really collecting extraordinary, I think, quantitative and qualitative data there. So very helpful. Martin, would love to turn over to you again, a little bit of context and color for sort of what Just was doing prior, what you're doing now, and where you think this is going. Thank you.
Sure. Thank you, Georgia. And good morning, everybody. Thanks to Diana and the Columbia team. It's kind of fitting that Just Capital was actually born at Columbia in a Deepak Chopra classroom back in 2013. And it's also interesting that the inspiration for Just sort of came after the 07-08 financial crisis, where it was clear there was a lot of unrest and unhappiness. And the question that Deepak was sort of wrestling with was, how can companies better serve society? What is the deeper connection between the private sector and society? And that sort of intellectual journey for him led to this concept of a just company. What does a just company mean? What does it look like? Just being something different than good or responsible or ethical somehow implies being wiser and being able to make the right decisions, even if it's not necessarily making everybody happy. He then, through a series of relationships, found Paul Tudor Jones, who's obviously a very successful investor, trader, and also a very successful philanthropist in New York City with Robin Hood Foundation. And between the two of them, Just Capital was born. So we're a 501c3 nonprofit, and our mission is to build a more just economy that works for all Americans. And we do that really by trying to influence the behavior of the largest publicly traded corporations. And we've learned a lot over the 6 years that we've been around. Deepak once said to me, people behave differently when you turn a light on in a dark room. And that's sort of what data does. It's sort of how we feel about what we do. We're really trying to shed light on how large companies are performing on issues of greatest importance to you, the public. Not what we think is important, but how the American people want companies to be, including making money. So we have, over the years, done a huge amount of survey work all around America, really trying to understand how people think about large corporations and what they want them to do. And it's actually a very intelligent, very explicit breakdown of issues. And every year, the most important set of issues has been how a company treats its workers. We have 5 basic stakeholder categories: workers, how a company treats its customers, the communities where it operates, the environment, and lastly, its shareholders, and is it well governed? And underneath each one of those criteria are a set of more specific issues. All of that comes from the public. It's actually one of the biggest criticisms that people leveled at us at the beginning was, well, the American people don't know anything, so why would you ask them what matters? And actually, it turns out you get a very common sense, quite sort of, as John Goldstein from Goldman would call it, a very kitchen table, old school set of principles. So, which is kind of interesting. So that's sort of what we measure. And then we have a team of about 35 people. We're based in New York City, who gathers the best data that we can to track what companies are actually doing on those things. We then take that research and all the data, and we produce rankings, we produce other forms of sort of tools and products that the market can use to essentially make more informed choices. We are at heart, in our particular role in society, we are really trying to empower the market to make more informed decisions. And the leap of faith you take is that people actually do want to invest in and work for and buy from and otherwise support companies that are doing the right thing. And that acts as the carrot that the market must have, and the stick as well, because if people, don't want to buy your product because you don't pay frontline workers well or you treat people badly, that's market forces at work, and that's a good thing. So, but without the information, people can't make those choices. Of course, demand for that information is much greater and very strong right now in the investment world where I come from. And so we spend a lot of time providing data and building products to the financial community. We built investable indices. Those indices have outperformed their benchmarks. Even in the last 3 months, we've seen companies that support workers well outperform those that don't. And I'll come back to that in a moment. But I think that that's going to fundamentally shift the focus of the ESG community much more in favor of the S going forward. We also know that companies themselves want to be better. So Alison, my colleague, Alison Almond, and the whole corporate engagement team with Yusuf George, and we have a whole sort of effort underway to sort of build programs that focus on specific issues. One of the things we've learned over the years is it's not enough to put data out there. You actually have to work with companies. We call it the inside game, where you're trying to get companies to change. A lot of this is about behavior change. Nick Hanauer talks about shifting the narrative. That's exactly right, because we've had 50 years of shareholder primacy, and that's not going to change overnight. So when you're trying to change behaviors and change norms, that requires a sustained effort on multiple fronts. And it's also not just about the message, it's about the messenger, which is why we try to we have a big board, and we try to leverage the voices of our board, but we also go to places where the conversation needs to change, where we need to talk about things in a different way. For example, the work we've done with CNBC, we put CEOs of companies that we think are doing the right thing by way of their workers, or on climate, for example, and on CNBC Squawk Box, where they go on and not, instead of talking about earnings, they're talking about all the awesome things they're doing to raise wages. The best example of that I've seen is Dan Shulman at PayPal, who conducted a financial distress test of his employees, found that frontline workers, the call center workers in Omaha were, and other places were very sort of financially distressed and incredibly unproductive as a result, understandably. And so, he could have fired them, I suppose, but instead he raised wages, lowered the cost of benefits, provided financial education for them, gave them equity in the company, and saw, the business benefits. So that's a good example of how investing in your workers and seeing it as an investment that generates a return actually benefits all of a company's stakeholders, including their shareholders. But that message doesn't get out well enough. We need to have a system change, not great anecdotes or great individual examples. It requires both. It requires individual leadership, and it requires system change as well. So we sort of see, in many ways, our role as being sort of enablers of those like yourselves who are trying to change the system. And hopefully you'll use our data and use our platforms. One of the advantages of being a 501c3, very transparent. We can put the data out there. We want people to use it. Stakeholder capitalism was on the rise. We were in Davos in January. We had the BRT last year. The Business Roundtable embraced a new statement of purpose for a corporation, which reflected creating value for all stakeholders. Very important milestone. Even if you think that it was just marketing, it's a very important milestone in my view. And the World Economic Forum, of course, the whole theme of Davos this year in January was stakeholder capitalism and how do you make that work? But in the course of a month, everything changed. And, we reacted quickly I think we recognized early on that this was a defining moment actually for stakeholder capitalism, because if you can't look after your workers and your customers in the middle of a global pandemic, when can you? So we felt like this was the acid test. So we put up this tracker on our website where we began to track how the 100 largest employers were doing on a range of issues related to their stakeholders, in particular focus on their workers. What were they doing on paid sick leave? What were they doing on hazard pay? What were they doing on furloughs and layoffs? What were they doing on executive compensation? And we just put it out there, all the raw data. And it became the single most successful thing we've ever done. We had a huge amount of inbound traffic. I mean, March was in the midst of, closing the office, getting the virus myself, everything, it felt like the world is crashing down. We had our most successful month, and then April beat March. And I think the reason for that was all of a sudden, everybody, companies, the media, financial media, investors wanted to know what were companies doing right now on these issues. And in particular, what were they doing to protect their stakeholders and their workers? And we were the only ones who had that information in a searchable database that had done a lot of the work of organizing that information. And so we learned a lot actually over the last couple of months. And, my view after talking to lots and lots of companies that we're tracking and investors who use our data, is that I do think that this has been, we're at a crossroads. If you just look at economics, the debt that we now have as a country, the kind of economic growth that we need to pull ourselves out of this mess with this level of unemployment, it's sort of post-Great Depression, post-World War II level. And it's sector-wide, so it's not just the financial sector. And that economically, you can't generate that kind of growth unless everybody feels like they have a stake in the outcome. And that's what we feel was the message of stakeholder capitalism before, that this was just, morally, put that aside for a second, just economically didn't make any sense. When you have 40, 50, 60% of the population rising in some demographics to almost 90%, who just feel like the economy is working for other people who are already rich, people who are already, the sort of owners of capital. That's not going to work anymore. And the idea of a short-term shareholder primacy pulling us out of this, I think a lot of people have realized that that actually is not the path forward. It's just doesn't give enough people enough of a stake to feel like that's going to work. And I think there's a potential risk of serious backlash if we go back to that. So the idea of a stakeholder-based approach, I think, is gathering momentum. I think we've seen a rise in importance of the S in ESG. We've seen companies, as I said, there's an extremely strong business case. You know, I'm old enough to remember sort of how the ESG and the stakeholder capitalism movement has sort of grown over the last 20, 25 years. And the E became dominant because of a series of major environmental catastrophes, disasters, and then climate risk. Equally, governance became much more important after, for example, you know, Enron and WorldCom in the early 2000s. I think this has been a major, moment like that, but times, 100 or 1,000 for the S. So I think people are much more aware of the importance of that. I think that we know now what it is we're talking about. You know, this is not in the realm of some academic conversation, some ideal. This is about paying people well, paying people fairly, providing good benefits. For example, as we've seen in the middle of this crisis, companies providing, increasing hourly wages, extending paid sick leave to 14 days. We've seen companies make those changes permanent. Darden Restaurants, the owner of Olive Garden, made paid sick leave for all employees permanent as a result of this crisis. How much of the changes that we've seen across all the companies that we've been tracking, how much of that becomes permanent is going to be a real test of where we go from here. I'm optimistic. I wouldn't do what I do if I wasn't an optimist, but I'm also a realist about what drives change. And I think, companies will now come out of this realizing that resilience is much greater when you manage to create value for all your stakeholders. Those companies that have managed to do that well so far will come out of this much stronger. They will write the script for how you become a much stronger company all around, including for your shareholders, by addressing all your stakeholder needs. And I think what has to come now is, okay, what do we do from here? Stakeholder capitalism, great, but what does that mean in terms of an operating model? Because it's not enough just to declare allegiance to that ideology, or that approach. We now have to turn that into an operating model and an operating framework, and that's what Just Capital is trying to do. So I'll stop there and look forward to questions. Thanks, Georgia.
All right, Martin, thank you. And Diana reminds me that we really have a hard stop at 9. I think that we get cut off. So what I'm going to try to do, and there are loads of questions, and, we can't get to most of them. I've tried to group a few, I think, by topic, and I think, and to be continued on all of this. I mean, I'll share to the extent that you all are available, or we do another round of this in a couple of weeks. That would be terrific. So let me raise 3 sets of questions, I think, and we'll try to get to the first 2 maybe and see where we are. The first, I think there are a number of questions, and I think we would be remiss really not to talk about, real economic inequality, racial inequality, and some of the more marginalized folks. So I want to get to, I'll pose a question there. And a second, I think actually has to do a little bit with whether UBI and cash and basic income, Nick, but to others, it could be considered a form of emergency savings or financial security for folks. But Liz, to group a bunch of the race questions, I want to start with the easy one. For you, you mentioned, I was encouraged to hear that you said, you are seeing capital flowing to companies. And, I saw this very cynical article, I think last week in the Times, about Mark Andreessen saying, we have to build, and he's, you know, putting venture money into sort of silly-ish social media apps. Are you seeing dollars flow to women entrepreneurs, to women investors, to people of color, African Americans? I mean, you know, obviously we see the health data in New York City and elsewhere. We see the poverty data. They track very closely. So I just would really want to, you know, ask head on the racial inequality question when it comes to access to capital, which was always a problem. Does that remain a problem? And also someone asked questions about, you know, the frontline workers, and, you know, whether it's, you know, public sector workers in New York, or whether it's workers in meat packing factories. So from the corporate perspective as well, but let's start with the, you know, access to capital and investor perspective.
So, I mean, it's been 3 months, and just based on what's been in our pipeline in these past few months, we've seen a few companies that so our investment thesis focuses on tech companies that can potentially offer venture-like returns. So we're looking at things that are very scalable, but have a solution that focuses on low income baked into it. So there aren't these trade-offs that we think people have to make. So, you know, cash flow based underwriting, point of sale loans for continued education, you know, telemedicine for nutrition, etc. So in terms of, I don't think in my experience in these last 3 months, I haven't seen come across women and minorities being funded just in the last 3 months of the pipeline I have. I wouldn't say that has changed. You know, it's always a smaller group. I think when you're talking about mission-oriented companies, they tend to be led by people of diversity. We tried to fund, our first 2 funds were sort of majority women and minority owned, but I think it's tricky to find that. One thing I can comment on in terms of my own experience, as we are still an open fund in our third fund, is that some of the institutional investors who were interested in a woman-led fund in investing but felt we were too small have revisited that. And so there's an interesting move I've seen from institutional investors scrambling to have solutions, and looking for people with a track record, and knowing that you're looking for emerging managers who are smaller. Because the criteria for venture and the criteria for investing in venture capital managers has always been, call me when you're bigger. And there's been this, you know, so for startups, being a friends and family round is not accessible to people who don't have wealthy friends and family. And diverse managers have to get to a certain size before they can attract the real dollars to scale. And so I am seeing a little shift there. I'm seeing people waiving those kind of criteria to try and be more inclusive.
From the corporate perspective, any comments about you know, specific corporate measures vis-a-vis diversity that you've seen change in the crisis, and or, you know, specific policies? Nick, you mentioned a whole bunch that are potentially have the possibility to create more financial security. Do you see any progress there on the racial dimension?
In a word, no. The focus has been on protection of workers generally, protection of frontline workers in particular, extension of benefits, things like that. We're tracking all of that. It's not broken down. We do know that the vast majority of frontline workers in various sectors, the people most at risk, are people of color, often women more than men. And so there's a built-in bias there anyway. So I think but we haven't seen explicit changes in the way large corporations have approached that. And I think in many ways that's going to play out, you know, over the next 3 to 6 months as we see what companies are actually doing on things like layoffs and furloughs. Right now, you've seen a lot of layoffs announced. We're starting to see them actually kick in. And we're also starting to see those benefits drop off. So I think there are 3 or 4 companies at the end of May whose hazard pay drops off. So I think if this is what we're really talking about here, are not changes during the crisis, but already embedded problems and issues and challenges that corporate America is facing.
Yeah, Georgia, and I would just add that I think one of the journeys that Commonwealth's on with all of our work is, and experts in this field of race and gender equity that we've worked with, is it's important what you measure. And so I think making explicit these issues of race and gender equity in the measurements we do on worker financial security and the impacts will be very, very important, as opposed to sort of proxy of low to moderate income and so forth. The other thing I'll say, I know time is short, on the question you mentioned about UBI, we have a lab that works on designing and testing innovations, and we have a great report on our site and just did a webinar about our project with the Worker Strength Fund, where we ran a test of providing cash grants and seeing how that played out. And there's a lot of great data there. It plays a part. It's not a substitute for all the things that I talked about. It's one piece of the puzzle, and it does have impacts, but it doesn't solve everything. So there's a lot to be learned as the UBI policy conversation plays out, and how sort of basic income is handled by families and so forth. So there's a lot of learning going on around that particular topic. But what's playing out with corporations is this issue of emergency hardship grants, cash assistance, and how you sort of solve short-term crises to keep employees engaged and get them back to work, which, as Martin said, some companies, not all, are starting to do. And then I think the question of how we bring the laggards along is an important one, and how we raise up everyone to a common floor.
Okay, thank you. And maybe with 1 minute remaining, there have been a number of questions. Martin, you're focused obviously on large, Fortune 500 publicly traded companies. Liz, you're looking at much smaller and earlier stage ventures, private ones. We see bright points in both. Martin, you mentioned, shining a light on corporate behavior, whereas Liz, you're seeing companies that don't have that light shone on them. Are we more optimistic about the large ones? Are we, are we more optimistic about the smaller ones? Is it all hands on deck? And just how do we think about this from, even just from an employment data perspective?
Well, on the large corporations, there's a question in here about how do you know what's actually going on? Employees would dispute, and I totally agree with that. It's very difficult to get information. To Nick's point, this is partly about, you have to have a policy framework as well. And there's a question in here about the role of policy. And I think that's right. You want intelligent policies that incentivize companies, reward companies for doing, the right thing, but also provide the floor. And we see our role as really trying to focus on the incentives, the rewards, the market-based reasons for changing. I think corporate America and many companies want to be better, want to do better. There's individual leadership at all levels of companies that we talk to. And I think there are many internal and external barriers, but gradually those are eroding. So I'm optimistic. We're going to see companies embracing much more of a meaningful stakeholder model, not a notional ideal. But you need the data. Without the data, you can't hold companies to account. We don't know what's going on truly inside of companies that we're tracking. So it's one thing to have a policy to say you're awesome. It's another thing for someone to be able to know that in fact you are awesome. You wouldn't invest in a company that had a policy to be profitable. You'd want to actually see that they were going to make money. So that's what I feel has to happen in the stakeholder ESG world. We must have the ability to have reliable data so that we can understand trade-offs. You can see how the use of capital is going to generate returns across all stakeholders. That's a great decision-making framework, but you can hold companies to account. That's what markets have to do.
All right, we may get cut off, and if we get cut off, otherwise I'm going to give the last word over to Liz on small business, but I'd like to thank my colleagues at Columbia Business School at the Tamer Center. This is a terrific series, and I appreciate it, and I hope I can grab you all back. Liz, if we don't get cut off, last word to you. We're all lucky to have friends who sort of know and see issues and problems and challenges and opportunities long before they come. And in early March, Liz called me and she said, I'm really concerned about small businesses. Liz, how are you thinking now about small businesses? Is this more of a challenge, more of an opportunity?
I think one of the things I would say is that in order to get to have the transparency into small businesses, you're going to have to change the way we're interacting with them. The SBA 7A loan is a 90-day process that's incredibly cumbersome and difficult to get money into the hands of small businesses. But if you look at some of the tech that's out there, like QuickBooks and Square and Stripe and all the things that small businesses interact with every day, they've collected so much information on those businesses that you do not need a loan officer to determine their liquidity and their risk profile. So you can look at the data that exists if you can partner with the tech companies out there on small businesses and start to do loans to those businesses quickly. And I think that that is different from 2008. That we are now in a position where small businesses, you can look at Toast and understand a restaurant's liquidity and understand their cash flows, and you can lend to them. And I think that's a unique position, and that's what we really have to double down on to help them.
All right, terrific. So I promised I'd get everybody on their way this morning, but again, thank you to Liz, Nick, and Martin, and everyone who's joined, my colleagues at Columbia. Really grateful for your time. And have a good day, everyone.
Thank you.
Thank you.
Thanks.